the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take you through how the Singapore stock market fared today, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. Well, Singapore shares dipped today after starting the week in the green. So the Straits Times Index was down 0.24% at 4,196 points at about 11:30 a.m. Singapore time, and that is with a value turnover of some 503 million Sing dollars seen in the broader market. But as we shared with you earlier, the STI eked out gains towards the end of the trading day. So let's take you through the closing numbers. So the STI wrapped up the day with marginal gains up 0.03% at 4,208 points. In terms of value turnover, we're looking at 1.34 billion Sing dollars. Gainers outnumbered losers 329 versus 229. Top advances for today, we've got for you GMH USD, ACES and New Incorporation USD, and top decliners, we have here UOB, UOI and OCBC. Now, in terms of counters to watch, we have CapitaLand Investment because its subsidiary, Bursa Malaysia-listed CapitaLand Malaysia Trust, posted a distribution per unit of 1.18 sen, that is SEN, for the second quarter ended June 2025, which is up 0.9% from the year-ago period. Now, elsewhere from the S&P 500 index ending above 6,300 points for the first time, to how Softbank and OpenAI Stargate is reportedly aiming to build a small data center by the end of the year. We've got more international and corporate headlines in focus. And joining me on the line is Jeremy Tan, CEO of Tiger Fund Management. Jeremy, welcome back to the show.
Hi, Tian Tian. Thank you for having me.
Great to have you. And Jeremy, let's start with global markets this time around. We've seen a largely positive session on Wall Street, where the S&P 500 index ended above 6,300 points for the first time with the current earnings season underway. What are the levels to watch then for the benchmark index as well as the Nasdaq Composite, which also locked a record high?
Well, if you look at the overall U.S. markets, definitely they are all trading at the all-time high level. Post-Liberation Day, we have already seen a V-shaped recovery across major indices. So looking at the S&P 500 right now, trading at above 6,300 levels, this is already above the median target set by economies and market participants. Right now, the S&P 500 is trading at about 23 times PE, while the Nasdaq is also trading at near all-time high level, almost reaching 21,000 levels, trading at about 28 times PE. So overall, definitely markets are all-time high, valuations are also at all-time highs. Last week, we did see a number of very strong positive news for the markets. As we have seen, for instance, the passing of the major cryptocurrency, the Genius Act, that I think will lend a bit of more policy clarity for stable coins that will become more prevalent and become more adopted by the masses. And also, in the last week, we also did see AI companies also benefiting from NVIDIA's and AMD's exports easing into China. I think that will also increase the revenue momentum for AI companies, especially now they can actually export some of their chips into China, which is a very big market that was previously being banned. And also a couple of weeks ago, we did see a very big, massive spending bill, the big, beautiful bill by Trump, that will also increase the overall fiscal debt to about 3 trillion over the next decade. I think in the short run, that will also lend momentum and perhaps more animal spirits to market, given the size of the spending bill and the tax cuts that are in place for the big, beautiful bill. So while overall valuations continue to remain high for U.S. markets, trading about 23 times for S&P 500, and even for the CAPE PE ratio, which is the cyclically adjusted PE ratio for S&P 500. This is actually crossing 38, which is the third highest in history. across history, I think this is, I would say, in terms of valuation, is really trading at all-time highs. But I think given the amount of clarity in terms of policy, in terms of the earnings growth momentum by AI companies in the S&P 500 AI companies, I think that will actually justify the current valuation. In fact, we think that there's currently a regime change in the overall markets that will actually cause the overall re-rating of U.S. markets and global markets further.
Okay. And, Jeremy, if we go back to the Singapore stock market as usual, how would you assess STI performance today? Any surprises when it comes down to the biggest movers or the sectors that they lie in?
Well, I think for STI Index, I think year to date they have also done very well. Right now, STI Index is also trading at all-time high levels, above 4,200 levels. I think right now there's probably a consolidation phase, given that last night, even on Wall Street, there was a positive performance. STI actually fell during intraday by about 0.2% before eking out a small gain at close. I think the consolidation of STI would be in place. I think the market will want to look out for more, I would say, news flow from the U.S. companies that are actually coming out earnings, especially for Tesla and Google. They're slated to report their earnings this week. And I would think that probably other than the earnings cycle, the market participants are also looking out for perhaps more clarity on the Fed, given that July FOMC, there is really, right now the market is really pricing in very low probability of a rate cut. So I think there is perhaps a lot of positive news that's being priced into STI currently. And as a result, today we have seen a number of cyclical names that have fallen, especially for banking stocks like UOB, OCBC, they have corrected. And a number of REITs that are actually sensitive to interest rates cut cycle, they have also corrected today as well.
Okay. And Jeremy, if you could take a look at CapitaLand Investment, its subsidiary CapitaLand Malaysia Trust posted a DPU of 1.18 cent, I believe Malaysian cents, for the second quarter, which is up 0.9% from the year ago period. How would you read into the numbers, and how far have they been factored into CapitaLand Investment's share price today?
Well, I think the overall DPU growth is definitely a very key important matrix for REITs in Singapore. I think that will actually signal that the income distribution for unit holders is actually on the positive momentum growing. That actually signifies a resilience in rental income and occupancy rates, and as well as a better cost management. So for CLMT, that actually reported a 0.9% year-on-year growth in terms of their DPU to the tune of 1.18 cent in the second quarter. I think that indicates actually modest growth in CLMT's performance. And overall, I would say that the overall operational performance for this Malaysian real estate portfolio is actually growing slightly. While that said, I think for the Singapore-listed CapitaLand Investment, I think that that actually owns a stake in CLMT. I think this probably is more of a muted set of results for them. I think the share price didn't really actually move. In fact, we think that the move has already been priced into the stock for CapitaLand Investments. And I think going forward, I think for the overall REIT sector, I think we definitely continue to see positive momentum, given that in Singapore we continue to see interest rate falling, and that is actually a positive backdrop for the overall REIT environment. So I think we could continue to see investors, looking at investing into REIT sector, given the higher interest margin from that point of view.
I see. And another counter that we want to look at, Jeremy, we in fact have not talked about this counter before. It is GHY Culture and Media. And quite interesting what's going on, because the company announced its tie-up with leading Chinese online entertainment service provider iQIYI to produce 2 short-form dramas, and this collaboration aligns with the firm's business strategies and growth plans to create more monetization opportunities. How would you read into the move, given the growing consumption of such short-form content?
Well, I think for GHY culture and media, this is probably a smaller cap company that not many people know about. I think for them, in terms of the core operations, they are in the business of doing content production, talent management, and also IP development, translating that IP into sort of films, series, and merchandises as part of their revenue verticals. So for this GHY Media, the partnership with ITE to actually produce a couple of short dramas, I think this will be sort of a positive set of news for them, given that this vertical, in terms of short form content, is probably well demanded by the youth, the millennials today, given their short attention span. We have seen the success of YouTube, TikTok videos that are in place. So them moving into this space, producing shorter form video content for ITE, I think this is probably a move that will actually diversify away from their talent management business, and also positive in terms of the overall demand for short video consumption by the market.
Now, across the region, Jeremy, we must talk about minutes from the Reserve Bank of Australia's latest policy meeting. Now, in the minutes, Australia's central bank judged lowering interest rates for a third time within 4 meetings, not consistent with its strategy of easing in a cautious and gradual manner, a reason that it shocked markets by holding steady this month. What do you make of the latest comments, and how are investors taking in the news?
I think investors looking at the pause in rates were slightly shocked for the RBA to hold the rate steady at 3.85%. Given that, year to date, we have seen that unemployment actually in Australia actually jumping in June from 4.1% in May to 4.3% in June. And also, if you look at the overall headline inflation in May, that has actually also fallen from 2.3% forecast to 2.1%. So overall, you can see that this is a set of factors that will allow RBA to actually cut rates further, but they have actually paused. I think they were trying to be more prudent rather than stalling the overall easing of the interest rate cut cycle, given that there is still a lot of concerns, given that there is uncertainty in the overall tariff landscape that is still uncertain at this point in time. They are looking at the headline inflation number, probably not reflective of the future. That could inflation could probably be stoked, given the tariff plans with Trump, with Australia, has not been really ironed out.
Now, from Australia, Jeremy, let's set our sights on China, because China's biggest shipping company is reportedly set to join the global consortium that is acquiring Hong Kong tycoon Li Ka-shing's overseas ports, and is requesting a powerful role in the group in order to secure Beijing's blessings for the controversial deal. So if we go by what sources familiar with the matter said, they said state-owned China COSCO Shipping is asking to have veto rights or equivalent powers in the entity taking over the 43 ports, and that includes 2 strategically important ones along the Panama Canal. What do you think the move means for players including Hutchison Holdings, given the ongoing US-China rivalry?
Well, I think it's not. It doesn't come as a surprise, given that there is a lot of pushback with this acquisition by BlackRock and the consortium for this Hutchison's ports, given that also one of the, in fact, 2 of the ports were actually very strategic, one of them being the Panama Canal. This is a very strategic port between, the major shipping routes. This actually handles about 40% of U.S. container traffic, and also approximately about 5% of global trade. So this is actually a very strategic port that perhaps China doesn't want, the U.S. To have control, and that's why it actually wants COSCO Shipping to have veto powers on this acquisition. And in light of the rising geopolitical environment between U.S., China, the East and the West, and major other countries, I think that despite this, I think I would say that China will probably want to have more control over such of these assets. And even some of these assets that tend to be more defensive in nature, I think they I think we as investors should look at it as more of, there should be more political risk, geopolitical risk that should be attributed to their valuation when we are actually buying into some of these ports, when we thought that they were actually very defensive, but actually there is actually a geopolitical risk element to investing in some of these ports.
Yeah, and finally, before we let you go, Jeremy, a Wall Street Journal report noted that Stargate, which is a multi-billion-dollar project or effort by OpenAI, Softbank and Oracle to supercharge the US's AI ambitions, it is now setting a more modest goal of building a small data center by the end of the year, likely in Ohio. How far is this in line with your expectations or the expectations of market participants?
Well, I think the initial $500 billion investments that was being launched by Trump with OpenAI, SoftBank, and Oracle, I think this is really, in fact, a very high expectation. I think, in fact, we didn't think that this would probably be launched in the short run, given the size of it. I think there's right now a lot of internal disagreements by the key partners with the key terms in finding site locations, and there's going to be a lot of delays, especially of AI project that's of this scale. And right now we are also seeing that the joint venture being struggling. In fact, OpenAI right now is going ahead to actually securing the computing power needs from Oracle. Some $30 billion of data center has already been signed with Oracle for the 4.5 gigawatt of computing power. So with that said, I think that given the delays that's happening with this consortium, with this Stargate project, I think a lot of that demand has already moved forward, given the urgency of it.
Okay, I suppose lots to watch on this front as well. Thanks so much for the insights, Jeremy. That was Jeremy Tan, CEO of Tiger Fund Management. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.